morning and thanks for tuning in. You're watching All You Need to Know on Bloomberg Quint Live and I'm Alex Matthew. First, the headlines. Asian stocks are mixed at the start with the Nikkei in Japan gaining as much as 0.3%. The latest Federal Reserve minutes temper expectations of future rate cuts and show signs that unity in the FOMC may just be fraying. A 35 basis point cut from the RBI is aimed at showing urgency for banks to pass on the rate cuts, according to the minutes of the last MPC meet. The Sebi board approves tighter norms for mutual fund investments and easier rules for foreign portfolio investors as proposed by the HR Khan panel. And the CBI arrested former Finance Minister P. Chidambaram in relation to the INEX media case after high drama at his residence last night. Let's talk about the US markets now. They paired gains and treasuries fell as Federal Reserve minutes fell short of signaling that the central bank was ready to cut rates sharply. Renita Young of Bloomberg News tells you what happened in that session on Wall Street in this report.
Risk was back on during Wednesday's session as U.S. markets ended higher. However, the S&P 500 backed away from that intraday high closer toward the end of the session. Investors are still awaiting more information on monetary policy. Much of this will come on Friday as Fed Chair Jay Powell gives his keynote speech at Jackson Hole. And we're still in the middle of corporate earnings season with results bolstering confidence in the world's largest economy. One of the latest companies to report was Target, boosting its full-year earnings per share and shares rising on that. Lowe's also gaining as its second quarter earnings per share beat analyst estimates. They both defied recession fears during the most recent quarter. Next up, we'll have Nordstrom and Victoria's Secret owner L Brands. Meanwhile, treasuries fell and the Fed meeting minutes, which were released during the session, showed that officials stressed the need for a flexible Federal Reserve. And we saw the Bloomberg Dollar Spot Index hovering around unchanged during the session. And that's a look at your Wednesday Wall Street action. In New York, I'm Renita Young for Bloomberg News.
Let's take a look at the Asian markets as well. Sophie Kamruddin is joining us live from the Bloomberg studios in Hong Kong. Good morning, Sophie. A few more markets coming on stream right now. How are they looking right now?
Well, Asian stocks, we are seeing them modestly drift higher as we have both volumes and volatility waning ahead of Friday's Jackson Hole conference. And in the bond space, treasuries are looking steady after a bear flattening move following the Fed minutes that sparked a brief inversion in the 2-10 yield curve. And bond futures remain under pressure after a choppy session in the wake of Germany selling 30-year bonds at a record low yield of minus 11 basis points. Indicative then of investor sentiment as the pile of negative yielding debt that nears $17 trillion. Now in equity markets, Korea, that is the outlier today, with the Kospi set to snap a 3-day gain, and Aussie shares are resuming the advance with earnings very much in focus. Qantas has reversed an earlier loss to gain as much as 5% in Sydney on its planned share buyback and prospects of a brighter outlook after the drop in full-year profit for the carrier. Now, the Shanghai Composite is edging just closer to that 2,900 points level, and here in Hong Kong, it is an earnings deluge with Samsonite among the names that reported overnight, and that stock is popping at the open here in Hong Kong. And the Hang Seng then just holding overnight gains as companies listed on the index do face the worst earnings recession since 2008, and the index then is headed for the biggest quarterly decline since 2015. Back to you.
Thanks so much for that, Sophie. All right, now one of the big influencers in yesterday's session on Wall Street was the minutes of the last meeting of the Fed, which was released on Wednesday, and that showed a diverse meeting on many fronts last month when a divided Fed cut interest rates for the first time in a decade. But the consensus to not reveal their intentions was clear and may show that the steady browbeating by US President Donald Trump has begun to influence how the Fed communicates. He has come out saying that the Fed let people down. Listen in.
The Federal Reserve has let us down. They missed the call. They raised them too fast. They raised it too high, and they did quantitative tightening. They shouldn't have done the tightening, and they shouldn't have raised them to the extent. We could have had some raises, but nothing like they did.
Well, what came out in the minutes was that the cut that did take place, the first in a decade, was in order to ensure that there was economic growth while also proving to counter too low inflation. Let's talk about what is to come, though, and all eyes will likely be on the Fed Chair Jerome Powell's speech on Friday. Michael McKee of Bloomberg News reports from Jackson Hole.
We're expecting a bit of a signal. The problem for Powell is the markets are definitely expecting a signal. And if he doesn't give them any kind of green light to continue their belief in a September rate cut, you may see a backup that the administration and the Fed doesn't want. So we do expect Jay Powell to say something along the lines of mid-course correction or insurance policy, although he may want to keep his options open because the data are still fairly strong, and not go too far in promising how much they're going to do.
And Mike, of course, this year's conference theme is called Challenges for Monetary Policy. This is a pretty appropriate topic, isn't it?
Well, sometimes you're lucky and sometimes you're good. In this case, maybe the Kansas City Fed got a bit of both in choosing that topic. However, the idea of challenges for monetary policy really reflects the idea that the Fed and other central banks at this point in time need to learn how to do policy when we go into recession and interest rates are extremely low. Used to be you could cut 500 or 600 basis points, but nobody's got that kind of room anymore. So what do you do? How do you use communication? How do you use quantitative easing? Are there other strategies that would work? That's the main theme of the conference, even if a rate cut is sort of what everybody walks in here thinking about.
And Mike, of course, we had the FOMC minutes from the July meeting just this afternoon. That really sent some ripples through the bond markets. What did you take away from it?
Well, it appears basically to ratify what they did and suggests that if they want to do it again in September, the conditions they were talking about, the uncertainty over trade issues, that sort of thing, still remain. Business caution about spending. What we don't know is how they're going to react if we still see the consumer side of the ledger come in strong. Jobs have been strong, and so has retail spending. If that continues, and if inflation ticks up a bit, do they want to pause in September and wait and see if something more is needed? That's still a possibility. We'll get a better idea of that after Jay Powell speaks on Friday.
All right, let's have a look at what else is making headlines across the globe. Ritika Gupta of Bloomberg News brings you the first word headlines.
The U.S. budget deficit is growing faster than expected, and the Congressional Budget Office says President Trump's trade war is a key drag on the economy. The shortfall is set to widen to $1 trillion by fiscal 2020, up from an estimated $960 billion in the year ending September 30th. In January, the Budget Office forecast a deficit of $980 billion next year and didn't see it topping $1 trillion until 2022. Minutes from the last Fed meeting show policymakers viewed their rate cut as insurance against weak inflation and the risk of a slump in business investment triggered by the trade war. The FOMC says they wanted to improve their policy stance to counter the effects of uncertainty and slowing global growth. It was the first Fed rate cut since 2008, but President Trump says it's not enough and is calling for a bigger cut. The UK and Germany both say they favour a negotiated Brexit, but neither side can say how that will happen. Prime Minister Boris Johnson and Chancellor Angela Merkel adopted an optimistic tone after talks in Berlin, with both repeating their wish for an amicable split. Johnson now heads for talks with President Emmanuel Macron in Paris, with France saying a no-deal Brexit is now the likeliest scenario. The unrest in Hong Kong is set to inflict more damage on the economy, with housing rents seen in decline. The Royal Institute of Chartered Surveyors says rents on Hong Kong Island will fall 2% next year, a complete reversal from the 3% gain seen in a previous report just as the protests began in June. Jones Lang LaSalle says office vacancy rates in Central hit a 3-year high last month. And the Singapore Prime Minister has won online support over his salary from none other than his wife. Lee Hsien Loong earns $1.6 million according to the government website, and he's faced local criticism amid the widening income gap. His wife took to Facebook, pointing out that other leaders enjoy many more perks than Lee, including butlers, hairdressers, and free flights on national airlines. Global news. 24 hours a day on air and at TikTok on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
All right, let's turn to trade in India. Agam Vakil is here to set you up for that and also to tell you what to look forward to with regard to futures and options. Agam, as of now, a bit of a negative start indicated, but that could change.
Yes, very well could, Alex. Well, at least as far as the SGX Nifty futures are, what they're showing, we're looking at marginally decline as far as the Nifty is concerned. But let's move on and talk about your indices yesterday. There was weakness, and we did see weakness across. It was broad-based, which is why we saw selling in the Nifty, mid-cap and the small-cap indices too. The banking indices didn't exactly perform very well or were up to the mark. The ADRs for now are seeing a declines. Tata Motors taking a hit of around 7.5%. Do remember, it was the biggest loser yesterday on the Nifty 50 index as well. And besides that, we aren't looking at too much movement, and even in terms of the other ADRs, we haven't seen as much of a decline as much as what we've seen in Tata Motors. But 770 odd crores worth of selling from FIIs and DIs by just less than half of that, in fact. In terms of contributors, it's ITC, HDFC, as well as L&T, which have actually, bear down on the indices, and that's possibly the reason why you do see a little bit of weakness. But the selling was broad-based, and we hardly had any gainers except for something like an Infosys or an HDFC Bank. Moving on to futures and options, what we did see was about more shorts added into the system, considering the Nifty went down, and we saw an increase of around 3% in the Nifty futures. The Nifty banking futures saw a 9.5% increase in open interest towards fresh shorts. So there certainly is a little more selling pressure coming through in the futures and options space. As far as your open interest distribution is concerned, the picture hasn't really changed. It's largely around the 11,000 mark, where you see a lot of writing. Of course, the 11,100 is the one with the maximum open interest for now, 11,100 calls specifically. And the kind of writing that we saw yesterday explains why there is so much traction around the 11,000 and 11,100 calls. The VIX did rise by another 2.5% at around and above the mark of 17. The Nifty put call ratio also edged lower, considering we saw the indices come off as well. So that's back below the mark of 1 now at 0.94. The One Housing Finance IDBI Bank remain in the F&O band, and besides that, we're keeping an eye on Birla Soft, which is under tremendous pressure, and there's more selling coming through, as was the case for Raymond, Manappuram Finance, and Tata Motors, of course. Watch out for that, considering the kind of weakness that we've seen. Apollo Hospitals, on the other hand, looking at some longs unwinding. Max Financial, Reliance Infra, and BHEL. Max Financials, where technicals are looking very, very interesting, so keep an eye on that one as well. So a mixed year of trade, Alex. Let's wait and watch as to how things pan out today as well.
Thanks so much for that, Agam. All right, one of the headlines yesterday was the Sebi board meet, and the Sebi in fact announced a slew of measures aimed at trying to close loopholes and increase participation in equities. But perhaps the most important aspect would likely be the adoption of the HR Khan Working Group's recommendations on foreign portfolio investor regulations. Sajid Mangat sums it all up.
The board of Sebi made some key announcements today, which includes the major one is simplification of the FPI regime. The board has taken some of the recommendations of the Khan committee and simplified and rationalized it. The FPI categories have been brought down to 2 from 3, which basically means some of the entities which fell in category 2 have been clubbed as part of category 1, and the remaining categories have been clubbed into category 2. The second thing was they have reviewed the risk profiling of FPIs. On the fund management part of it, they have basically allowed offshore funds of Indian mutual funds to be registered as FPIs going forward. And finally, there has been some rationalization of the ODI instruments or the P-note regime, which has happened. The details are still awaited on that, but that's some of the key things which is coming from FPI. Over and above that, some of the innovator companies, how to migrate them to the main board. Some recommendations have been approved by the board. There has been a review of the buyback especially with respect to companies who are coming out with buybacks and those having subsidiaries which are in the financial services. The board has approved simplification of that regime by allowing exclusion of the financial subsidies while calculating the consolidated debt equity ratio, which is kept at 2:1. The excluded subsidies, which is financial services, should have a debt equity ratio of 6:1 for the buyback to get approval from the board. Over and above that, mutual fund regime has been tightened a bit, where investment into unlisted debt instruments in a particular scheme has been brought down to 10% from 25%, and there has been some kind of whistleblower mechanism put in where Sebi has provided some incentives and regulatory framework to bring in informants so that they can participate and help in the investigation of many of the cases which are pending or future cases going forward. The CRA regime has also been tightened a bit, where credit rating agencies are now required to sign an agreement with the issuer, which allows them to get all information from financial services companies and banks and lenders. This will allow more disclosures and transparency with respect to information on loans, defaults and delays.
So all likely far-reaching changes in regulation, and if you'd like to look at them in more detail, they're all available in stories, multiple stories on the website bloombergquint.com, so do check them out. For now, let's turn to the Monetary Policy Committee, who voted to cut policy rates for the fourth time this year. You probably remember that because of the nature of the cut, that was 35 basis points. Now, the 6-member panel believed that weak growth warranted further monetary easing, but the MPC broke convention to cut rates by 35 basis points instead of a 25 or a 50. Pallavi Nahata brings you the highlights from the minutes of that policy meeting to understand why.
The Monetary Policy Committee had left policy watchers surprised when it chose to cut rates by 35 basis points, citing weakening economic growth. The minutes of the MPC meet, which were released on Wednesday, give us some insights into why the MPC cut rates and why it chose to cut rates by 35 basis points. Shaktikanta Das, RBI governor, said that it can no longer be business as usual given the current and evolving inflation and growth scenario, and that the economy needs a larger push. Ravindra Jalakia said that reviving growth required several economic reforms which were not within the purview of monetary policy except for the correction of high real interest rates to a certain extent. Judging the extent of the slowdown is the key issue, according to Michael Patra's statement, which also called for a broad-based policy response involving all policy levers. He cautioned that the space for monetary policy action has to be calibrated to evolving situations from here on. At its August meet, the RBI once again revised growth forecast to 6.9% for the full financial year. Even as reviving growth continues to take center stage at MPC, Chetan Ghate again flagged off possible fiscal risks. He reiterated that large public sector borrowings can be detrimental to the economy. He added that going forward, policy coordination between monetary and fiscal policy will be crucial for a healthier and more durable growth inflation mix in the economy. Ravindra Jalakia countered Ghate's view on fiscal risks, stating that fiscal slippage is not a matter of concern.
All right, with that, let's turn to the stocks that you have to watch out for and trade today. Yash Upadhyay is joining me now to tell you all about that. Good morning, Yash. What's on your list today?
Morning, Alex. So the NMDC saga continues for a third successive day now. Earlier, the Karnataka government had cancelled the lease for the Donimalai iron ore mines and had put it on lease. But now the state government has in fact received a stay order from the High Court until the next date of hearing for putting the iron ore mines on lease. Additionally, they've also for the first time after 2 months have cut prices for the lump ore and fine prices by 200 tons per annum, citing falling global prices, while lump and fine ore prices there continue to remain steady at 2,900 rupees and 2,660 rupees per ton respectively. Kansai Nerolac is in focus as well after the company has decided to sell its adhesive construction chemicals and sealants business, which is Polygen, to Neurofix for about 20 crore rupees. Another day, another big bulk deal to watch out for. LIC Housing Finance will be in focus as well, after there's reports that undisclosed institutional investors are looking to sell close to 3.37 crore shares in the company to raise about $211 million. The price range for the offer would be in the range of 425 to 450, which stands at a discount of anywhere between 3 to 8.5% based on its closing price yesterday. Coffee Day Enterprise, there was a report that came out yesterday just before the market end where ITC was set to pick up a stake, but the company has come out and clarified indeed that the report is not correct. However, ITC has stated that they have received queries from an intermediary of Coffee Day Enterprises. BHEL, India Ratings has changed the outlook from stable to negative for the company while maintaining the AA+ rating on the stock. And key bulk deals to watch, NRB Bearings would be in focus as well, because we've seen that Acadia Conservation Fund, they have acquired close to 0.7% stake in the company at a price of 90 rupees each, while Gujarat Polys will be in focus as well, because Antara India Evergreen Fund, that has sold about 19 lakh shares of 4% stake in the company.
Thanks so much for that, Yash. But if you want to check out how any of these stocks pan out in trade, do tune in at 9 o'clock. There's live programming through the market day. For now, let's turn to one of the big developments yesterday. Shortly after Congress leader P. Chidambaram made a dramatic appearance at the AICC headquarters and addressed a news conference, he was picked up by the CBI for questioning in relation to the INX Media money laundering case. Here's a look at all that transpired yesterday.
As much as I believe in liberty, I also believe in the wisdom of our judges. So, friends, until Friday and beyond, let us hope that the lamp of liberty will shine bright and illuminate the whole country.
Totally a politically motivated witch hunt. This whole thing is being done only for theatrics and for voyeurism, for the pleasure of a few, and to divert the attention of the people of India from the serious issues.
From drama in politics to drama on the big screen, as Disney and Sony failed to reach a deal, Tom Holland's Spider-Man may just be going out of the Marvel Cinematic Universe. So what does this spat between the two mean for the future of Spider-Man? Take a look. let me take you through some of the stories you'll find on the website bloombergquint.com if you do take a look as of now. To facilitate recurring transactions and payments, the Reserve Bank of India has now allowed card issuers to provide an e-mandate facility to their customers from the 1st of September. Following several requests from the industry stakeholders, the RBI on Wednesday evening, that is yesterday evening, in a notification to all banks and card payment service providers said the e-mandate arrangement would be made available on debit and credit cards up to a limit of 2,000 rupees per transaction. To find out what that means for you, do look up the story. And Andhra Pradesh won't reopen all power purchase agreements for renegotiation, but will do so only in cases where there is manifest wrongdoing, according to Union Power Minister R.K. Singh, who said this referring to a statement issued by the state government. This comes, and that statement that he's referring to, it comes after the newly formed Andhra Pradesh government, led by Chief Minister Y.S. Jagan Mohan Reddy, said it was going to review power purchase agreements signed between the state's electricity distribution companies and power generators to renegotiate tariffs. That's all you need to know going into trade today. Do stay tuned though, there's a lot more coming up in just a short while. This is Bloomberg Quint.